halftime show, State of the Markets. We are off and running. So my name is Tyson Ray. I am a founding partner at Form Wealth Advisors and here to help walk through some perspective for the markets. I'm joined with Christine Hayward up in our Middleton office. Very exciting. And we get to talk about disclosures. Fun. There are three partners here at Form Wealth, all carrying different levels of certification and experience, and we custodian through Raymond James. And yet they did not put on this presentation. They give us a lot of different resources that we can use internally and externally, and we pulled from a lot of different places for today's perspective. This is not guaranteeing anything. It's talking about what happened in the past. It's also talking about what we think about in the future. And we appreciate you attending. As far as questions go, you get to email questions at form at Form Wealth. Kim, who helps coordinate a lot of this, is behind me, and she's going to be bellowing at me with a loud voice if we get questions coming in. And will interrupt me, and I can answer questions as we go. So feel free to zip off an email to that form at Form Wealth, and we will try and get your questions answered that way. So a little bit of review of today's agenda, what has happened, kind of what is driving things, and what is going to be happening, or at least what do we think the trends are going to be going forward. So let's get started. So first, we're going to talk about the U.S. markets, specifically the S&P 500 index. It is the 500 largest companies publicly traded in the United States. You could probably name them all. It is actually something you can't invest in and of itself. There are investments that mirror it. We have projections. So this was done in December of last year. So COVID's, the year of COVID, if you will, comes to the end in 2020, and firms put out their projections for 2021. And the market projections are interesting to me because ever since COVID, people have been underestimating how good things are or are going to be, because the projection from last year projected that the market would end up somewhere around 4,200, and right now the market's trading above the 4,400 mark. So basically every major firm was too pessimistic, and we believe they're remaining too pessimistic in how well things are recovering. So why is that? Well, for one reason is we're technically in a recession, and yet most recessions are supposed to be painful. The tech bubble was especially painful, much more so the financial crisis. Those events were either leverage. In the tech bubble was leverage, that people leveraged their portfolios. They borrowed against their portfolios and bought more into these equity markets. They borrowed from their houses to leverage themselves into the market because it was euphoric. We haven't actually had a euphoric market, at least in the equity markets, since. Doesn't mean it won't happen again sometime. The financial crisis was we got over leveraged in real estate for the most part, and people got allowed to buy homes that maybe weren't in a financial position to buy homes. And that one was quite painful. And yet this one has not been that. It was, we shut off the economy because we were concerned about COVID. And I would say we panicked. I'll talk about that more in a minute. And then we turned it back on and really have never looked back. And what's driving that is not euphoric. It is not the Fed printing money necessarily. What's driving that is what drives the markets, stocks over time more than anything else, and it's their earnings. And the earnings are the profits, if you will, the income these companies are making. And over time, you've seen, if you can see my little cursor here, I think it's better if I use this little cursor. Mouse, here we go. Maybe not. Can you see my cursor, Kim? Okay, great. So again, sometimes the markets have been above earnings. Sometimes earnings got above the markets. They tend to trend each other quite highly. And basically, we shut off the economy. The market corrected. Earnings corrected because people panicked. Businesses were shutting down. Then we turned the economy back on. They took back off. And that's a big predictor of the future of returns, or what are these earnings, and what drives the markets more than anything else. What drives the performance or the returns you get of your investments is the underlying earnings of those companies. And so I want to talk a little bit about what that looks like. This is June of last year. Very important to catch this date, June 30th of last year. This was Raymond James's research. And so basically we knew that in 2019, we had very flat earnings growth and that the market was getting a little toppy. Now we're a few months into COVID and we're projecting that for 2020, the average earnings growth was going to be a reduction of earnings of about 22%. So the expectations were the markets were going to be doing in 2020 something in the 180, 190 range. And then when COVID hit, it dropped dramatically, thinking about a 22% decline. And then some recovery from that decline in 2021 to get back to maybe where we were in 2019. Again, this is a year ago, give or take. Then fast forward to this is June of this year, a year later. What ended up happening was the decline wasn't 22%, it was only 13. Again, we became too pessimistic. And the expectations of what 2021 was going to look like was again too pessimistic, because part of the reason the markets are recovering is we went from expecting to be at 192, and now we're expecting to be more like 198, 190. So we're almost a 37% increase. This again was through June of this year. I went and grabbed the most recent research because at the end of June, we were putting this together, and yet we got the second quarter numbers, and we also got the companies themselves giving us some of these estimates going forward. And now it's more like a 44% return. And so it is continuing to improve. We're expecting almost a 10% in 2022 and a little less than that in 2023. A number of about 230 on overall earnings of the company. Again, these are the companies themselves giving us these estimates. We're collecting these. Raymond James estimate then assumes a little bit better than what we're expecting because they've been too pessimistic. But where does that end up putting us? Again, that 2030 number is up here for earnings. So if that earning line is projected to go up here for the next year based on the feedback of all these companies, it would tell me there's a high likelihood that the prices at the very least may stabilize, if not continue that upward trend. And what's ironic to me is no one believes it. And yet there's the fundamentals that are driving why we are overweighted equities and have been going all the way back into COVID, which I'll talk about here in a minute. A picture of what earnings looked like. We've had earnings recessions in the past. We actually had a little blip of an earnings recession, different from an economic recession. An earnings recession in 2019, everybody will remember that that Christmas was kind of bad that year, and then it completely recovered. And then COVID hit, and then we got this fallout, and now we've had the recovery in earnings with the expectation in the next year or two here, we're going to come back above where we were. Different from other recessions where they maybe would have been more severe, I would say, and took longer to recover. For those of you that have attended a few of these, we used this next slide of about 20 different indicators of what's going on in the economy, whether or not what's the monetary policy looking like, what's the economic outlook looking like, interest rates. There's 20 different things in here. I'm not going to go over all of them, but what I want to highlight is, again, because we use these over time, this is the snapshot from June of last year. So this is June 2020. This is 3 months, give or take, into COVID. We've shut the economy down. We're kind of finding out that we can turn on maybe about half the economy is essential. And what you're seeing here is 7 of the 20 dials are red, meaning bad. 9 are yellow, and only 4 are green. And then I want to fast forward to January of this year, and the colors change a little bit, and you end up having now only 2 are red, 8 are yellow, and 10 are green. So now it's more green than it is anything else, and that's a positive as it's trending. And then again through April was the last data we had for this. Now you have 17 green, only 3 yellow, nothing's red. And so again, things are moving in a positive direction. A different piece of research that kind of displays the same, it comes out of ClearBridge. It's a recession indicator, and this kind of shows what the markets look like as you went into severe recessions in the past, and then it showed what 2020 looked like. So the economy wasn't really set up or wasn't teed up to have some type of major correction. It wasn't overheating, if you will, even though we shut it off because of COVID. But currently, I mean, it is green across the board, and that means it's very unlikely that something's going to derail the economy, even the Delta variant, because the difference between the Delta variant and COVID was originally, we didn't know what COVID was and what it was going to do to us. We know a lot more now than we did. then. And if the Delta variant was going to be an issue, you'd have in both the consumer business activity and the financial markets more concern than we have. And to again reiterate how things have been improving from December to March to now, it's been moving to the green, and it's likely to stay green here for a while. And the reason for that is, and this is my of all the information I've taken in from all the different resources over the last year and a half with everything that's transpired with COVID, I'm about to share with you my opinion. And my opinion is we as a humanity across the world panicked. Not unlikely, I mean, not unexpected, because again, we didn't know what we were dealing with. And when we panicked, what I mean by that is this market sold off in record time. It set a record, dropping 34%. When we started really first even thinking that COVID was going to come here. Now, keep in mind, we had about a month and a half almost of watching China deal with it, because China locked up 60 million people in Wuhan at the end of January. And then we watched the cruise ship, remember that? And so we got spooked, and all of a sudden here it's in America. And as we got into this, and the market panicked, because the market, keep in mind, everybody doesn't understand this all the time. The market is projecting out a year and pricing in investments today. So basically, when you buy an investment, this entire next 12 months is priced in. So you don't really buy an investment for the next 12 months. In fact, you buy investment like you plant corn. You plant it and then you forget you have it, because it's going to take about a year and then beyond to start benefiting from that investment, because the markets are pricing in what they think is going to happen. Not what's happening today, it's what they think is going to happen in the next year. And so the reason the market sold off before we knew what was coming with COVID was because it's disrupting what they thought the next year was going to look like. And it became, this is really interesting to me, it became a almost a predictor of things, because how fast that market sold off, when we actually got the data to justify the market selling off, it was delayed, meaning the Fed back in May of 2020 put this out there, and they're basically saying about 2 weeks after the market bottomed. Now think about that. 2 weeks after the market bottomed, the mortality rate that they were tracking, they thought 27, almost 28% of people, or a third of deaths, were going to come from COVID. And what they ended up realizing was it wasn't that high. It's just people were dying of a lot of different reasons that also happened to have COVID as one of them. And then it dropped back down within a month, not even, back down to what would have been a normal flu season as far as a percentage of death is concerned. But what I find interesting is that sell-off happened right in here before the spike even took place. And so again, to reiterate, before you knew what the death percentage was going to be, the market sold off, because that's how spooked the whole world got. And yet at the same time, that market sold off when the policyholders were looking at this is when they were passing unprecedented stimulus and unemployment wages and benefits and stimulus for businesses, that they were shutting down the economy. I mean, we panicked. And in the light of panicking, we just injected a ton of capital into our economy and into people's hands to basically bring some type of stability to people now having to stay home and what to do with that. And yet you couldn't do anything with it because you couldn't go anywhere. Economy was shut down. And yet we opened up pretty quickly, and look at what happened. The market started completely recovering. And what I find fascinating, and what I want to point out about how the markets trade into the future, is you would think psychologically it would make total sense that the markets would have sold off, or the markets would have bottomed when the COVID cases were the worst. And the exact opposite happened. The market sold off before we knew what kind of COVID was even going to be in the United States. And yet, when the market was reaching back its all-time highs towards the fall of last year, is when we had our worst COVID outbreak as a country. So our record, I mean, the market sold off back at right here in the end of March, before COVID even started picking up. And yet it spiked in November and December, and the market's reaching all-time highs. And why is that? It's because we knew what we were getting ourselves into. Back here, when we started, we didn't. And we also knew what the government did. We also knew what the Fed did. We also got to watch, how did China come out the other end of this? What was the rest of the world doing? And the same thing is, you wouldn't think the market would be reaching all-time highs when we're reaching the record death levels. And again, here's where the deaths took off, which is what spooked the market. They came back down. The market started recovering. They went back above the high. You would think the market should sell off. Didn't, again, because we knew a lot more. We knew we had vaccines coming. We knew not everyone was going to die from this. We knew it was really deadly for the age population of about 65 and older. And so it should not have been based on COVID that we reached record levels. And yet that's what we did. And again, the market gave an opportunity, unfortunately, for way too many people to panic out of the market, or panic because of any of that COVID data. And to the extent that those that panicked out of the market's up almost 92% through the end of June from where they panicked out, or for anybody that panicked out because they made the decision based on the peak of COVID deaths, or they thought, we were shutting back down again at the end of last year, or the different events that have transpired that caused people to be concerned, they got out. And we just feel that an all or nothing decision with the investments doesn't make sense, especially going forward, even with the Delta variant. And the reason being is, for one thing, we know that over 86% of the population over the age of 65 has gotten at least one dose, and about 3 out of 4 people are fully vaccinated. We know it doesn't prevent them from getting COVID, but we do know it dramatically reduces their ability to die from it or have long-term consequences. We've also learned that, wait a second, shutting down the economy wasn't necessary because it didn't have the same effect on the younger populations. And so we may go back into mandated masks. We may go back into some of the issues with the school the country's fussing about. Actually, there's some data out of the CDC that shows it really doesn't matter whether you wear a mask or not. And there's some data that they put out that, again, all these studies get a little bit confusing. My 2 cents is I think this is just the new flu. Because ironically, the actual influenza has gone to almost zero because you don't have the flu, you just have COVID, or that's the assumption. In the meantime, again, the market's looking past all that. And the market is looking, what is the market looking at? The market's looking at a couple things, and I'm going to hit on some of the things that are supposedly the concerns of the market. So if you take in any information about investments or you watch any of the news, one of the concerns is inflation. And Christine's going to talk about this a little bit more in a minute, but inflation going back to the 70s, in my opinion, is just in this long-term trend of somewhere between 0 and 5%, somewhere about 2.5%, and we're just coming back to that 2.5% range. And I don't think that's going to be a very big deal, especially with people's incomes being able to keep up with inflation, which is what's happening. That's reflected here. This is unemployment coming down. Again, we have a lot of people that are still unemployed, but our unemployment rate is back down to a 50-year average. The times that we dropped below 6% in the past that we were really excited about because you had all these people back to work and the economy's going strong. That may continue, but it doesn't necessarily need to, because for the last 50 years, 6% unemployment has served our country pretty well, especially when you have the yellow line up as well, which is wage growth. So if your unemployment sits in that 6% range and your wages are growing at 4% and your inflation grows at 2.5%, means your wages are growing more, you're making more money than the cost of the products you're buying are increasing. That is productive for our overall economy and a positive thing. Add to that, you have all kinds of homes for sale. The whole real estate market is going gangbusters, and that's partially because even with COVID and even with the COVID crisis, you have consumers' balance sheets the strongest they've ever been. People have more money than they've ever had, whether it's because their home went up, their investment portfolio went up, they've been saving it in cash, or all the above, and or they paid down their debts. Ironically, since the financial crisis, which is back here in the 08-09 era, we've almost doubled the net worth in the last, 13 years, 14 years as a country. And so there is a lot of buying power, and again, there's that growing wealth gives me confidence of how things are going to continue to go going forward, especially when you have record retail sales. So this is where, again, we shut off the economy, retail sales plummeted, the economy turned back on, and we all went shopping and haven't stopped, quite frankly. And some of us can't get what we even want to buy because they're running out of it. And that's probably going to continue because we had the savings rate that became unprecedented. Again, shut off the economy, and our savings rate went from an average of about 7% almost to as high as 30%. It's come back down. And these people that are saving, going back to when COVID was turned on, the Fed lowered rates to 0 to encourage people not to save. and yet they saved anyway because they were panicked. And I think way too many people are still afraid of something that is not something to be afraid of relative to the economy and to their investments. It's obviously something personally to be concerned about, and anything that reflects your health or your loved one's health. But from a finance standpoint, COVID is not going to be the thing that ends our world economies. It's not going to be. Again, I feel like it's just going to be the new flu. It was and is deadly, and yet we're coming and finding ways of dealing with that. Add one more slide or two here to this phenomenon. This is astounding to me. This is the household percentage of debt service as far as what you spend your income on, and it has continued to come down. Again, the financial crisis, people got over leveraged and then they learned their lesson, and you got to go back almost into the 80s to find a time where people had such positive cash flow relative to their debt. And the 80s and 90s, by the way, were some phenomenal years in the market. And so this is also some of the peace of mind that people were going into these higher markets or going into this economy moving forward with people in very, very good financial shape. And where's the opportunity? They don't feel it. The opportunity is that the average consumer is still concerned about this pandemic. Again, we shut off the economy and it's kind of come back, and the consumer sentiment, this is kind of the indicator of people's feelings. It's improving, but we haven't quite trended back up to where we were feeling really good about things. Keep in mind, that's not necessary. If I would say that's actually the opportunity, because again, coming out of the financial crisis, the markets did very, very well before the consumer felt very, very well. In fact, I feel the returns of the investments come before you realize them or before you feel like you can count on them. And it's almost a contrarian indicator for us is that when, if the economy gets really euphoric again, if you all love the markets again and investments, which was how the tech bubble was, we may be convincing you to move out of some of those investments. But in the meantime, we're thrilled with where those investments are. And so there are some headlines out there that we thought Christine would touch on. And so Christine, if I have this set up right, take it away.
Good, thank you. So as Tyson was saying, before we jump into our predictions for the rest of the year, what are some things that could potentially, ruin our optimistic 2021 year that we've been having? And the first is inflation. The feds keep saying that it is, they believe it's transitory. They don't feel that there's any reason to change their monetary policy or their bond purchase program, but what do investors think? What do the markets think? So I'll get into that in a little bit and go into more detail. The second piece could be bond yields. Not yet. Yeah. Sorry. That's okay. Well, you can leave that one out. The second is bond yields. With such a strong economic growth going on this year, a lot of investors are anticipating that bond yields will increase. But if that does happen faster or they go up higher than anticipated, that could make some investors nervous. And the third is really, something we could never anticipate, such as the pandemic, black swan event. We do see the Delta variant. Hopefully nothing else comes to pass this year, but there is always that third potential of something we would never think of. Obviously, we can't predict the future. We don't know what's going to happen, but these three pieces were items that I wanted to touch on. So when we're talking about interest rates, and there we go, if we can go to the next slide, please. Throughout my career, and well, since the 80s, we've been seeing the rates going down, and obviously you can see in certain years it peaks up here and there, but on average since the 80s you've been seeing these rates fall, and now we've been at close to zero since 2010. So we felt for a long time that prices have nowhere to go but up at this point. So what does that really mean for bonds? When we talk about bond prices and yields, if you could go to the next slide, they have an inverse relationship. So if the price rises, the yield typically falls. So what does that mean? If you're holding a bond and you sell it before maturity, it could be worth more or less than what you initially paid for it. What we typically recommend people do is, obviously barring any sort of default risk from the issuer, you want to hold it till maturity, because then you receive the interest rates along with the principal back. So if rates have nowhere to go but up, we're anticipating bond prices could go down. And that is something that investors are starting to become a little nervous about. and a piece that we feel is on the horizon as the Feds start to raise their rates. When we discuss inflation, and if you could go to the next slide, please. The first half of the year, there was a lot of increased anxiety about inflation. We've had pressures from everything, commodities, consumer goods, and we've also seen, I'm sure we all have a story about seeing supply chain bottlenecks. I don't know if any of you have tried to order furniture, and that's delayed almost a year. The worst one I heard was a refrigerator now. It'll be about 13 or 14 months until someone I know will get there. So we've seen that issue happening, but also consumer spending's increased. So with all of this concern, it may require the Fed to start tightening their monetary policy sooner rather than later. However, they believe, again, that inflation is just transitory, so they don't have any immediate plans to do anything about it. But as you can see here, based on this graph, the markets don't necessarily agree. So this is according to investor 10-year inflation expectations, and that's what this chart is showing us. And the expectations are rising. Given that investors largely anticipated the economic rebound from the pandemic lows last year, they're worried that inflation might be more persistent than what the Feds are saying. I think the next 6 months will really give us a better idea as to, are we on track for the Fed's 2% target? Or, is monthly inflation reporting going to show us it's actually going to be a higher move? But then that leads us into the question of, well, what do we anticipate? Is this going to be rampant inflation or the old normal? So the anticipation, if we're looking at the current 3-month average, we're at 2.8. Well, if you go back to 98 through 2014, it was a 2.9% average. So we're actually below what the old normal used to be from 98 to 2014. So no, we're not worried about rampant inflation coming down the pipeline anytime soon. We're actually anticipating less than what we've seen throughout the early 2000s.
Thank you. So a brief reminder. So for if you have questions, you get to email them at forum@formwealth. I see one of you is raising your hands to ask a question, and for whatever reason, well, the regulators are the reason. The regulators are allowing us to do these seminars virtually. However, they're struggling with their policies that go back to when we they created these rules back when we used to communicate with letters. And so they view questions as correspondence, and so they want them emailed because we can capture those and supervise those. And they don't want to do live questions. I don't like it, but we are ethical and we follow the rules here. So if you have a question, because I see one of you trying to raise your hand and ask it, please email at it's form, F-O-R-M, @formwealth, and we'll be happy to get that answered for you. Or you can call us after this is over and we can actually have a dialogue with you. So in wrapping up and trying to stay focused on some things, I spent the last part of the slide bringing some interesting slides that I've come across over the last few months that really give me some perspective that I think is missing in this day and age and what's going on. I think the first is to put in perspective how much stimulus, or to put in perspective, I think how much we've both panicked and how political this has gotten. The amount of stimulus that we've passed to deal with COVID is unprecedented. It is every other crisis we've had going back to 1980 added together. Every other recession we've had since 1980 added together as a percentage of our GDP. And so the byproduct of that should be one phenomenal economy coming out of this. And it's the reason why most people aren't experiencing some of the pain that normally recession would provide, even for those that are unemployed. There are concerns over raising taxes depending on where you sit politically. What I was surprised to find out is that higher taxes actually generate some very good returns in the market. For the years we had tax rate increases, the market returns were actually higher than the years we had tax cuts. And the reason that is, it's counterintuitive, but the reason that is a lot of times tax increases are paying for more government spending. Obviously, if the government's raising the tax rate, it's because they're usually trying to pay for something. And these major companies are often best positioned or politically aligned to financially benefit from what those dollars that they're raising taxes for are going to be spent on. And so that is a misunderstanding. Obviously, they can raise taxes too much and that may have an effect. But generally speaking, they tend to average out to be about the exact same, which tax increases or decreases tend to not be a big deal. What is a big deal, and what I most pay attention to going back to when I started my career in 1998, is what are the companies themselves doing? So a company, everybody forgets this, but a company makes profits. And they can do a couple things. They can go and design a new product, and that's R&D. They can spend the money to try and make their company better. They can sit in cash. They can buy another company. That's R&D, or not R&D. That's basically mergers and acquisitions, M&A. They can issue a dividend. And up until about, I don't know, 2 or 3 decades ago, now they can actually buy back their stock. And there's some political controversy over this, but the difference between a dividend and the difference between buying back the stock is basically the same. It's to benefit the shareholders. And what I mean by that is a dividend is where if you own the company, they issue you effectively a little quarterly part of the profits as a form of a dividend, as a payment of some of the profits of the company or earnings of the company that are paid to the shareholders. Throughout the past, that has been when they issue a dividend, it's issued and then it's constant. So if they increase the dividend, they increase it for forever. And if they decrease the dividend, the market tends to view that as the company's having a problem and they get punished for that. And so with a tax law change that happened back in the late 80s, the companies can basically issue dividends or buy their stock back. Buying back their stock, they have to announce that they're going to buy back their stock or how much stock they may buy back, but it's voluntary. And every year it can change. And when COVID hit, what we found is that they dramatically reduced the amount of shares they both announced and or bought back, and yet are continuing to announce now share buybacks. And specifically in the financial sector, when COVID hit and the Fed did what they did back last March and April, they actually restricted the banks from being able to buy back their stock, wanting to make sure the banks had enough cash to ride through the uncertainty of this economic experiment of shutting off the economy. And in fact, it was only just a few months ago that they've removed that restriction, and banks are now, or financial companies are now allowed to buy back their stock. It's buying back that stock that is one of the underpinnings, in my opinion, of the market. It's not when mom and pop decide to go buy a couple hundred shares of their favorite company. It's when the companies themselves go back into the marketplace and buy back their own stock, or build a portfolio with their cash of other companies, which is also happening. And so I'm excited to see that, because again, that's a positive going forward. If the companies are buying back their own stock, those CEOs are some very smart people, and they're looking at their business and they think if their business is going to do better going forward, why not own more of their business effectively? And so that's where they go back and buy their stock back, often at times when people are panicking out of their stock and they see that that price is worth buying back from the individual who's willing to give it up, often being short-sighted of what the future could hold if they would just ride it out. The other thing that we're hearing all the noise about is, yes, what about the record debts? What about all the stimulus that we've spent money on? It is unprecedented in the form of the actual dollar amount. It's not unprecedented as based on a percentage of the economy at the time. We have some pretty decent, it's now the second biggest deficit we've run relative to our GDP. Nothing compared to World War II yet. Dollar-wise, it's greater than World War II, but as a percentage of our economy, it's not. Keep in mind that if our economy grows off of this stimulus, effectively, that should continue to be less of a percentage of GDP, which is what the hope is. But what people are failing to realize is that when you hear these different headlines and you want to anchor yourself on any one of these political issues, make sure you clearly understand what they're talking about. Because one could say the US deficit is at record levels. And that's true based on the specific number of dollars that we're talking about. Just like the house that you most recently bought was probably the most expensive house you bought in terms of real dollars compared to what you bought maybe 20 or 30 years ago. But relative to your percentage of income you're making or the percentage of the economy, the deficit is not at a record level. Or to the extent that you bought a house recently, it may not be, or at least as far as the rest of America is concerned, it's not as big a percentage of their income as it was 2 or 3 decades ago. So that's why they're able to do that. And then from a servicing of the debt standpoint, so, okay, you have this debt, but now you got to pay interest payments on the debt. Going back to the 1980s, it's only about 2% or so of the right now of our interest expense relative to our GDP, relative to our economy, to service the debt. And so what America's been doing for the last 20 or 30 years is deciding that we're going to borrow this money and we're going to build out our economy, and we're going to try and make things better for businesses and roads and infrastructure and some of the less fortunate, if you will, in our society. And we're willing to borrow some of our growth to fund that. And the issue is, if interest rates go up dramatically, that can increase quite a bit. But historically speaking, we've been able to do this for a long time. And the expectation is we'll be able to continue to do that for a long time. That's all interesting to me. What I find most fascinating is this next slide, because where our real growth is going to come from for the rest of my lifetime and my kids' lifetime is demographically. America is one of the best positioned countries relative to the number of people we have, because if you don't have any people, you can't have an economy. And if you don't bring more people into your economy, or if your economy doesn't grow, you can't grow your overall economy. And so what I want to show you here is from 2000 to 2019. So for the last 20 years, give or take, Japan's demographic actually shrunk. They actually have less people than they had back in 2000. Keep in mind, Japan's prosperity in the 80s and 90s was amazing. And then as they had an economic downturn, the people kind of got downcast, and they just haven't reproduced because they don't want to bring other people into their downcast state. And that's become perpetual. So Japan has a very aging population that didn't have a lot of kids to replace them, and it's basically an island. It's only so big, and they have some problems over there, and they have quite a bit of debt. And the projection for the next 20 years is it's going to decline even more. Interestingly, Europe is getting a little old themselves. Germany, Italy, France to some extent. UK is a little different. Might be part of the reason they broke away from Europe, is because they have some demographics that will benefit them that they didn't want to get dragged down possibly with the rest of the European Union. But what I can tell you is in the last 20 years, the United States demographically has increased by 15%. We're projected to only increase by 4% going forward. I think that's probably a little low. But point being is that the baby boomers, the concern was they didn't have enough kids. They did not have enough children to replace themselves. Well, their kids had plenty of kids, because the millennials there are now more millennials walking around on the planet than there are baby boomers, or when there were baby boomers. And those little rascals are getting into their 30s, and they're buying cars and they're buying homes, and maybe they're finally moving out of their parents' basements. And most of them are making more money than their parents made because they went and got the educations they got. And our future is on their growth, how they have kids and what they do, but we are well positioned in that regard. So as I wrap this up, I want to show some of the consequences of panic and mistakes people make with their investments. So if you stayed fully invested over the last 15 years, you actually had a substantially better return than if you decided to panic out. So let's just assume you just decided to time the market perfectly, and with a $10,000 investment, you decided that in the last 15 years you could miss. You got out of the market and you were willing to miss a day or two of performance. If you missed just the 10 best days, you cut your return in that investment in half. And the reason for this is that a lot of times when the markets go down, when the market actually recovers, the market has a huge day that it sells off, it drops 2, 3, 4, 5, 10% in a day. Usually the next day or two, the market goes back up 3, 4, 5, 6, 7, 10%. And so for the people that panic out, and you don't panic out usually until it's gone down some, then when that market rebounds and you're out, you permanently sometimes miss that. And that's what this slide is reflecting. You don't have to miss many days to dramatically wipe your return out. And for some people that do this more than once, it can be absolutely devastating. Interesting study, because history is a wonderful guide. It happens to be the only one we have when we're talking about the future. An interesting study, and I wanted to put this as a poll question, is like if you had the option of buy and hold an investment for the long term for what we have for history, or you could consistently sell 10 months before the market peak and buy back 10 months after the market bottom, assuming you time that perfectly, right? You can get out 10 months before the market peak and you can get back in 10 months after the market bottomed. Which do you think is better? And to my surprise, and to a lot of people's surprise, it turns out that actually buying and holding is still better. Think about that for a minute. You could get out 10 months. You knew, you had like a predictor. I could get out 10 months beforehand. I'll miss that. I'll miss that downturn. And then 10 months later, I'll buy it back. And what I want you to realize in the fact that there is an enormous difference between those two returns is because if you're a long-term investor, which is where those returns come from, a 10 month to 10 months. So what is that? 20 months, a year and a half, give or take, is a long time to be out of the market. It's a long time for the market to keep going higher. It's a long time for the market to both correct and fully recover. Keep in mind, COVID, we lost a third of the portfolio values in the market value in almost 30 days. And then 2 months later, it completely recovered. Well, so if you got out 10 months before that, you missed all the growth up to the time the market corrected. And if you waited 10 months after that, you got back in at a higher level. And so market timing is just a facade, and it does more damage than it rewards the people that even try. And if you actually profit from it, you're just lucky. And we don't build portfolios or strategies based on luck, because we see what history shows us. And this is the daily price movement of the S&P 500. And what I want you to see is the spikes and valleys. You have back in the financial crisis, you had days that were 7, 8, 9% sell-offs, and you had 5, 6, 7% recovery days. In COVID, you had almost a day that was almost down 10% in a day. That panicked a lot of people, and people panic out of the market. But when people panic out of the market, it's what drives the market down. Usually it kind of compounds a little bit, and then buyers step in, and that's what you see with these recoveries. But what you notice is you don't have a 10% positive upswing, usually without some kind of equal downswing. And that's the mistake people realize, is oftentimes that when you finally reach your panic button and you run and finally sell, usually within a few days, you're regretting it. And that sometimes becomes a permanent loss, especially if you stay out, than a temporary one if you would have just ridden it out. And to again reiterate the trend of this going back throughout all of history, this is the worst days. So this is a chart showing of the worst days in the markets in all of history. 3 out of those worst days came last year with us shutting down the economy in that March timeframe. But what I would show you is of all these different bad days where the market dropped 20% in one day, that'd be a bad day. Yet a year later, the market recovered 23% up from that point. To the extent you had these bad days, the average of any one day in the market. So, hey, if you own investments, you could drop on average on the worst day ever, almost 9%. And yet a year later have recovered quite a bit. What I find interesting, if you go out, what are the worst months? Again, the worst month is about 11% with a recovery of about 22. Again, one of the worst months that we've had was in March of last year. The market dropped 34% starting in February, but then recovered before March ended. Otherwise, that number would be 34. But again, had quite a bit of recovery off that bottom. Lastly, what I'd show you is that your worst returns in the markets can actually come in these 3 to 6 month increments. If we're going to have a bear market, they tend to happen in a quarter or two, and yet have some substantial recoveries as well. And so it is the people that want to panic in these downturns that don't realize those are the times to buy. If you're not in the position to buy, certainly those are the times to hold. The mistake investors make is they don't give themselves a cushion. They don't allow themselves to make sure they have what they need in the next day, month, 3 months, year, set aside, sanctified, set apart from the portfolio to ride out those bad times. And that's a philosophy that we have here at Forum, is to try and help plan that you have a set aside what you need in advance of that need, so we can just ride out what historically have just been temporary returns. Because people are every year having an opportunity to complain. If you judge your portfolio value based on the highest level it's ever been, I don't know why you do that to yourself, but if you do, and some people do, every year the market has gone down from its all-time high, and then it's whether or not it recovers before the end of the year. And this chart is showing that picture. It's one of my favorite charts. It shows last year, right? We had a 34% downturn in the beginning of the year, and yet the year ended up 16%. And so for many months, you could have been all upset because from some high watermark, you went down a pretty significant percentage, but then a few months later made it back and then made a profit. And yet you could actually even still emotionally so attached to that downturn that you would tell me you lost money last year, when in actuality you didn't. You emotionally felt a downturn is what you had. And then you anchored that a feeling, and yet the facts of your portfolio reflect something entirely different. And part of our job as a financial advisor is to help you deal with those emotions and understand the facts more importantly, understand how all that needs to relate to your life and keep you from hurting yourself or your portfolio. And out of the last 35 years that this chart reflects, what I want to point out is of 35 years, you had 1 year that it was flat. You had 8 years that you had actual years that ended down. So it seems worse than it is, right? There's not many bars that end down. And you had 28 years that were positive. And the math works out to, at least for the last 35 years, you have about 70% of the time, 26 years out of 35, a little more than that, that the year will end positive. Not the day, not the month, not the quarter, but the year. If you give your investments a 12-month period of time, there's a very high likelihood that you'll have a positive return for that investment, or tolerating those fluctuations. But what we're hearing right now is, and what Christine and I hear all the time is, well, let's wait a second, the market's at an all-time high, or maybe we should take some money off the table. And we're only going to take money off the table is if what you're going to need to live off of in the next 12 months. But this whole concept of the market as an all-time high is a mistake. And the reason it's a mistake is because the markets have always been at an all-time high. It's kind of the market's at an all-time high compared to what? If we compare it from your birthday, the market's never done anything throughout your entire lifetime than go up. And if we want to anchor our decision on, well, this time's different and it's never going to recover, you can, but all the thought of that, that's not a really good plan to basically make your entire life savings based off of what if or a maybe, because the trends tend to tell us otherwise. And in fact, if we look at the long-term trends of the 1950s and tongue-tied, the 1950s and the 1970s, which I actually think is very likely what we're in right now, in part because we came out of World War II. Out of World War II, we had millions of people unemployed. Out of World War II, we had tons of stimulus that I showed you earlier. And out of World War II, there was a ton of people that were just happy to be alive, like all of us that survived COVID. And the 50s and 60s became really good years, gave us really good returns as people got back to a new way of living and a new life. And in that time frame, there were 365 all-time highs. So there was 365 times in that 20-year period of time, you could have used that as an excuse to not add more money. And you might have regretted that decision, because cumulatively that swung a positive return up about 450%. Went sideways for a little bit. And then we had the 80s and 90s. And again, there was 500 opportunities to say the market's at an all-time high. And yet that cumulative return was about 1,200% or more. And what I want to point out is that we feel, and Raymond James feels, and there's other economists feel, that we started a new uptrend coming out of the financial crisis, 2010. We've had 309 so far all-time highs, and we've only accumulated about 285%. And I say only because even if you go back to these other ones, there's more, at least historically speaking, time left for this trend to continue. And we have all this stimulus in the economy. We have really low debt levels. We have all these positive signs. The economy is all green. I don't see a reason to be worried or to think that the market couldn't go higher. And what I'd point out is that the odds of going to Vegas and making money is about 49%. Vegas gets about a 3% at the most benefit. And yet tons of people go there and gamble their money away trying to make a return. And yet history shows of all these time frames at an all-time high. If the market's at an all-time high, the next 12 months from that all-time high historically has been up about 8.6%, with about 70% of the time being positive. Interestingly, because this goes back to 1930, the slide I had earlier that went back to 1980 was about 70 as well. And so the odds are much more in your favor. If you give your investments time, you'll be rewarded from them. And our job is to help you set aside, when we have these all-time highs, when the markets are doing well, the money you need to live off of, to garnish the dividends, the interest, the profits that you have to set aside for you to live off of, and to keep you from panicking out of your investments when things like COVID, we're going to shut down our economy, or whatever the next thing's going to be that we're not going to know about until it happens, that isn't going to end the world, but it probably will feel like it. And so we appreciate the fact that at the end of the day, our job ultimately is to help you not do what everybody else does. There are people that do want to make investments in the markets because they want to avoid these little red downturns. And they're not little, they're painful usually when they happen, and they can be scary when they happen. But what I would tell you is they set up recoveries that most people miss, because they don't understand what they should be doing with their wealth. And our job is to help bridge that gap, keep you from panicking, help you build a portfolio that stands the test of time, that can help build a legacy that funds your lifestyle and can fund the legacy that you get to leave to those that you love or the community you're involved in. And it's the privilege that Christine and I have to do this. And so I thank you for letting us spend a little about 50 minutes here sharing. And I'm going to check to see, Kim, do we got questions?
No questions.
We got no questions, which means our little question functionality is not working, because I guarantee you some of you had questions. And so I'm still pushing back on some of the regulations we have to do with these, because I would rather have more dialogue. I liked having us all in a room, but we thought, again, with the whole Delta variant and mask, don't mask, what have you, we just do it virtually here. Again, if you have questions, reach out to Christine or myself. We're happy to answer those. And then go enjoy the rest of your day here if the rain holds off and we just can enjoy this month, August. And we'll touch base when we do another one of these, probably in the fall. And until then, have a great rest of your day.